One of the most important and often misunderstood parts of wealth management is how your financial plan actually connects to the way your investments are managed. That's exactly why we created this video. Inside our investment process, how planning and portfolios align. Because the real question isn't just what you're invested in, it's how decisions are made and how those decisions support what you're trying to accomplish. In our practice, that connection is foundational. Your financial plan defines where you're going, your goals, priorities, timelines, and the real life constraints that matter, like cash flow, risk, and tax considerations at a planning level. And then your investments are managed with discipline and intention to support that plan. Not in isolation and not reactively, but through a coordinated team and a repeatable investment process. Whether you're already a client and want a deeper look behind the scenes, or you're considering working with us, our goal today is to make the process clear and to showcase the depth of the investment team supporting our clients. I'm joined by Ben Fawcett, one of our lead portfolio managers. Ben co-manages our in-house equity portfolios and supports our advisory team on equities and capital markets. Ben, thanks for being here.
Great to be here, Sue.
Now, before we get into investment principles, a quick word on who this is for. We work with families across a range of complexity. Some situations are relatively straightforward. Others involve incorporated professionals, business owners, or families with multiple moving parts. Different account types, bigger decisions, and more planning considerations. Regardless of complexity, most people want the same thing: clarity, coordination, and confidence that their portfolio and plan are aligned. My role is to understand the full picture, build the overall plan, and set the strategy. Once that direction is clear, I bring in a deep team of investment professionals to help manage investments with the highest probability of success. Ben, once the plan sets the direction, why are investment principles so important?
There's a couple of key reasons here. The first one's being mistakes. So I have 25 odd years of professional money management experience, pension funds, mutual funds. And the biggest mistakes I see aren't analytical, they're behavioral. People lean too much into a theme, or they make emotional decisions when markets start to get a little unstable. That's why you need structure and you need discipline, which leads to the second point, which is consistency. You have a plan and you have a process, and you have to execute on that in good markets and bad markets. Again, structure and discipline. And finally, there's client experience. Can you thoughtfully manage volatility and risk so that clients can stay in the portfolio and reap the benefits of long-term compounding?
At a high level, how would you describe the philosophy that you use to build investment portfolios?
There's a couple of key elements here. One, it needs to be simple, it needs to be durable, and it needs to be repeatable. Again, this isn't a philosophy or principles designed for one specific type of market. This has to work when markets are going well, when markets aren't going so well, and everything that comes in between. So simple, durable, and repeatable.
And that brings us to the framework that you have developed. The principles that guide how you construct portfolios and manage risk. Maybe you can elaborate on some of your thoughts and processes around that.
I take a holistic approach to building a portfolio. Many people think you just take your best ideas, stick them together, there's your portfolio. But here's a stat for you. A good portfolio manager is only right on less than 55% of their calls.
Wow.
So that compounds over time to a lot of performance. But in the individual moment in time, it's almost a coin toss. So I'm very cognizant of the fact that at any given point, I could be wrong. And that's why I build a broad portfolio that's designed to operate in different types of environments.
So you're designing for resilience over certainty?
Exactly.
I've heard you talk about the all-weather portfolio. Can you explain to us what that really means?
The underarching idea here is that no single idea or decision basically determines the outcome for the whole portfolio. So we all know that if you have too many stocks in a portfolio, you look like the market. But the other side is, if you have too few stocks in a portfolio, you're adding a lot of volatility that's unnecessary. What I've found is around 40 stocks allows me to have each stock make a meaningful contribution to the portfolio without any individual stock determining the outcome of that portfolio.
So What's become more of a concern recently is increased volatility. Walk us through how you manage risk.
Yeah, risk is one of those areas that just doesn't get talked about enough when it comes to portfolio construction. But really, it's everything about how much risk are you taking to generate a given unit of return. So from a portfolio standpoint, there's actually a number of ways you can manage that volatility and that risk. The reality is you can't take it all out of there because that's what you have to endure to get the higher returns you get from equity markets. But at the same time, you can build a portfolio in a thoughtful way where you actually reduce the volatility and still end up in that same place as far as the returns in the long run.
I would love your perspective on market timing. What are your thoughts?
This is the biggest issue I find. This is the most expensive error investors make, pros included. The reality is there's a number of ways I could approach this, but let's look at it this way. If you missed the handful of biggest up days in the market, you would materially underperform. And the catch there is the day before those big moves is the day you most want to sell. That's the psychology of markets.
And we see that with clients so frequently, don't they?
Yeah, they want to sell right at the bottom and they want to be buying right at the top.
Okay.
And that's why market timing doesn't work in the long run. It's the biggest error investors make.
How do you use these principles to guide investment behavior?
I always say it's evidence over ego. Back when I was a portfolio manager, one of the early things I learned in a pension fund is never say you did something because of your gut feeling. You need a process. Not only have a process, there has to be a theoretical reason that works, and you have to be able to demonstrate how that works in different markets. Because again, that process, that's your North Star. That's when markets get difficult and you start feeling all the feelings, that's what you lean into, and those are your guardrails.
So sticking to that, especially during challenging times.
Especially in challenging times, because that's when it gets really difficult, and that's when you can do a lot of damage.
What's the significance of disciplined behavior as an investor?
It all comes down to consistency. Having that process and those guidelines and executing on them consistently. That's what leads to long-term outperformance.
Where does your edge come from?
I always have to remember markets are super competitive. So when you have a process, you have to have that discipline, and your edge comes from having a process and executing it consistently.
From a client's perspective, how do these principles show up in a tangible way? What would a client actually notice?
They notice thoughtful diversification across geographies and sectors. They notice that decisions are informed by a multidisciplinary approach, integrating different forms of research. So we're not just relying on one lens. And they'd also notice portfolios designed with liquidity and practicality in mind, built to be lived through real market cycles. The bigger point is this: the portfolio is designed to do the hard work for clients, so they don't feel compelled to make emotional decisions at the worst possible time.
And I think that's really where the alignment becomes powerful. The financial plan defines where we're going, and it also defines the constraints that make the strategy real. Timelines, cash flow needs, appropriate risk, and tax considerations at a planning level. Then the investment process defines how we get there through disciplined portfolio construction and risk management. It's built and managed specifically to support the plan. And on tax, while we coordinate implementation with your accountant and legal professionals, we're continuously thinking about tax at the strategy level. Account structure, cash flow timing, and how decisions may affect after-tax outcomes. Ben, from your side, how does a clear financial plan improve portfolio decisions?
Clear constraints make portfolio construction more precise. When we understand time horizon, liquidity needs, and risk tolerance, we can build with more intention and manage the portfolio more consistently.
To bring it back to the theme of this video, inside our investment process, how planning and portfolios align, our philosophy is consistent whether you're already a client or considering working with us. Strong outcomes come from clarity of direction and discipline in execution. Your financial plan defines where you're going. A dedicated investment team applies a thoughtful, evidence-based process to help you get there. It's not about reacting to markets, it's about aligning strategy, process, and people over time. Thanks for watching, and Ben, thanks for your expertise.
Thanks, Sue.